I feel like there's a fundamental flaw with trading penny stocks that nobody is talking about, and it drives me nuts. As an active trader, someone who's turned less than $600 into over 10 million, no, my results are not typical, but I mostly did it trading low-priced stocks. So I love low-priced stocks, but I'm not in love with penny stocks. When I became a full-time trader, I tried trading penny stocks and I learned the hard way. The biggest losses that I had in my career were trading actual penny stocks. So if you've lost money trading penny stocks, you're not alone. In this episode, I'm gonna share with you the 3 fundamental flaws with trading penny stocks. And I'm gonna share with you what I do that's a little bit different that's allowed me to be such a successful trader. Now, one of the flaws with penny stocks, it's not anything that you and I can control. It's actually a mechanism that regulators put into place in 1987 that even today has a significant effect on the way these low-price stocks trade. So there's a lot to cover. I've got my whiteboard, we've got screen share, so let's jump into today's episode on trading penny stocks. All right, so I have 2 perfect examples I'm gonna share with you. One is from the penny stock today that went up about 200%, and the other is from the penny stock yesterday that went up about 300%. Yes, we are in a penny stock hot cycle right now. This began about 2 weeks ago when we had a penny stock that went from about 30 cents a share up to over $11 a share in one day. And it caught short sellers off guard. Some of them just got destroyed. A lot of long traders made some money, and there are a lot more traders out there that coulda, woulda, shoulda, wanted to make more money on it than they did, saw this incredible opportunity that they didn't capitalize on, and said to themselves, I will not miss the next one. And so the next penny stock that has popped up with news has had that many more buyers. And it becomes a bit of a self-fulfilling prophecy because traders are like, I don't want to miss the next one. So they all buy the next one, and then the next one gets a ton of volume, starts to go up, but none of them have made a move as big as that one 2 weeks ago. Nonetheless, 200% or 300% is still a lot of opportunity. I think we need to make a distinction here between being an investor and being a trader. Which one are you? Now, I'm a trader, but I learned that the hard way. I started as an investor, so to speak, because some of my first trades, I bought into the hype. I bought the penny stock that, the penny stock alerts that people were emailing out. I bought into it. And I bought a huge position on a penny stock that I thought for sure was gonna be the next one that was gonna go to $2, $3 a share, and I'd make 30 grand or whatever it was. But as it started dropping, as the momentum faded, I kept holding. And I kept hoping that it would go back up, and it didn't. And I lost $15,000, which was a huge amount of money for me at that time. And I learned through that experience, and then many more over the years, that I wanted to be a trader. I wanted to reduce my exposure risk of holding stocks overnight because that felt uncomfortable. I wanted to make money consistently. I felt that I needed to. Well, this was my only job, so I really did need to make a little bit of money at least each week, if not every day. And so that really molded me to become a trader. And the type of trader that I am is a bit more of a momentum trader and a scalp trader, where I'm taking relatively quick trades, 5-minute long average hold time, getting in, getting profit, getting out. 5,000 shares, 10 cents, that's 500 bucks. I do that 10 times in one day and I'm up 5 grand. And just as an example of that, this is my P&L from right here today. You could see that. So $5,000 on the day trading the particular penny stock that I'll show you as we get further along in this episode. The thing that I realized is that if I wanted to be an investor, I needed a certain set of skills that I simply do not have. I would either need to be like a senator or, a congressman or whatever, because these guys seem to make a ton of money in the market. Or I would need to, be buddies with like Bill Ackman or Warren Buffett, or know a bunch of S&P 500 CEOs. Well, I'm not in that circle. I'm just a regular guy, grew up in Vermont. I have no connections like that whatsoever. So what edge would I possibly have? Now, could I do a ton of fundamental research and maybe find that needle in the haystack? Maybe, but it seems to me a lot easier to try to focus on being a trader, focus on using technical analysis, using these easily recognizable chart patterns to take a few trades each day, book a little profit, and move on. All right, so that's my strategy. That's the way I trade, but I don't like penny stocks. Well, this stock's going up 200% in one day, 300% in one day. What's not to like about that? There's three things, as I already mentioned, and the first is decimalization. So penny stocks, any stock below $1 trades not just in a 1 cent spread. So I'll get on the whiteboard here. So if a stock traded with a 1 cent spread, it looks like 85 cents by 86 cents. That would be a 1 cent spread. And that means if you bought 10,000 shares at 85 and sold 10,000 at 86, you'd make $100. All right. Well, that's not how it works. With penny stocks below $1 a share, they actually trade all the way down to the 1/100th of a penny, which means it can trade like that by like that. So what's crazy here is that for this stock to go from 85 cents to 95 cents, that's only 10 cents, but it's actually 10 increments of 100. That equals 1,000 price increments to get from 85 cents to 95 cents. I'm not going to draw 1,000, but you get the idea. Now, on the other hand, as soon as a stock crosses over $1 a share, 101 by 102, now you're back to getting your $100 on that 1 cent spread. And for this stock to go from 101 to 110, it really only is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 increments of 1 penny each. And for that reason, as soon as a stock breaks over $1 a share, they tend to move faster. So a stock price between $2 and $4 is going to move a lot faster in general than a stock price between 20 cents and 40 cents. The thing is, and this is what can be a little bit frustrating, a stock like the ones that we traded today or the day before that start at 50 cents a share, well, they have two problems. So the first problem, the first thing I don't like about these penny stocks is the issue with decimalization, that below $1 they trade down to the 1/100th of a penny. And the second issue is that these stocks become extremely congested, very crowded. And that's because in order to make money, you have to buy not just 5 or 10,000 shares, you've got to buy 50,000, 100,000 shares. And now you've got a level 2 where the order book is so stacked with sellers and buyers on both sides that the stock becomes a tug of war, and you don't get those quick 5 to 10 cent moves. So I like 5 to 10 cent moves because with 5,000 shares, I can book 250, to $500. But on a penny stock, you're not going to get 5 to 10 cent moves. Now you could say, Ross, well, no, that's fine. Just take your 1 to 2 cent move. But a 1 to 2 cent move, even though you could do that with a lot of shares, now you're getting in this position where you're using kind of like a lot of leverage for a really small sliver. But if that backfires on you, you have a lot of downside exposure because you took such a huge position. If you happen to have the bad, timing, misfortune of getting in right before someone presses the sell order on 500,000 shares, they're going to sweep the book and the stock is going to flush. That's going to be a problem. So there is exposure risk with taking really big size. And one of the big problems with these penny stocks is that they become very congested. So problem number 1, decimalization. Problem number 2 is congestion. And problem number 3 is the halt levels. So this is something that's pretty interesting. I actually wrote about it today in a blog post because I thought it was that interesting. So let me show you the example of these two stock charts. So right here, we've got, and let's see, we'll just move this like this, just so you can see it better. So on the left, we have INM, which was today's big momentum stock. You can see it's up 143%. You can see that right there, 143%. I just crossed it out, sorry about that. All right, so, and then on this side, you see INVO down 32% on the day. So the halt bands have been a real topic of conversation. In 1987, after the stock market crash, circuit breakers were introduced into the market, and these circuit breakers are volatility trading halts. So if a stock declines more than 10% in less than 5 minutes, the stock will be halted for a period of 5 minutes. It gives traders a chance to collect their bearings, and most importantly, it stops high frequency trading algorithms from spiraling, from running away and creating a flash crash. It stops everything in its tracks for a moment, 5 minutes. So the thing is, these halt bands are different on different priced stocks. And to give you a bit more of a description of how these work, let's look at the whiteboard again. So as a stock is moving up, around the price action at all times are volatility bands. And these volatility bands are spaced away from the price action 10%. So for a stock over $3, so for $3 and up, these bands are spaced 10% above the current price and 10% below the current price. For stocks between 75 cents and $3 a share, it's 20%. And for stocks below 75 cents a share, it's 15 cents or 75%. And this actually presents a really interesting issue that we had today. So today, and this price, the price right here, isn't based on the current price right now. It's based on the price the stock closed at yesterday. So yesterday, INM, which was up 200% today, yesterday it closed at 50 cents. So it's actually down in this tier right here. It closed at 50 cents, which means every 15 cents the stock is getting halted. Remember that circuit breaker halts don't work pre-market or after hours, but they work between 9:30 and 4 p.m., so regular trading hours. So if we look at the stock chart just for a moment, yesterday on INVO, you'll notice that pre-market we have this sort of regular trading. It's grinding up. It's very thickly traded. It's very hard to make any money on it. And then at the open, suddenly it squeezes and halts up. So it trades for like, a minute, then it halts up. It's halted for 5 minutes. Then it resumes and it squeezes up and halts again. And then it's halted for another 5 minutes. Then it instantly halts down and it's halted for another 5 minutes. And then it halts back up and it's halted for 5 minutes. And again for 5 minutes. And then it goes up and then it halts down for 5 minutes. And so even though hours were going by, this was spending more of the time being halted than actually trading. And it's because the volatility bands were 15 cents away. So the way these bands work, by the way, is it's the average price over the last 5 minutes. And it updates approximately every 30 seconds. So that's why I have these little lines. So this is the band for 30 seconds approximately, and then it updates. So it's constantly updating to 10% away in the case of a $3 stock or higher. 20% for a 75 cent to $3 stock, or 15 cents for something that closed at under 75 cents. It's constantly updating that distance from the average price of the last 5 minutes. So it's constantly moving. Now, in order for a stock to actually be halted, it needs to be pinned at the top of this volatility band for at least 15 seconds. And then the stock will get halted for a minimum of 5 minutes. This is giving you a little bit of a tutorial of the circuit breaker trading halt thresholds and the volatility bands, but it's been a major issue. So these stocks have been just getting halted left and right. And I think this is actually what's even more interesting. So let's look back at this example here. All right, so let's see. So this example here, if we look at this, there we go. So if we look at this example, INM yesterday was 50 cents a share or so. So today, even though it's at $1.41 right now, it's gonna halt every 15 cents. If it goes 15 cents within less than 5 minutes, it'll halt. So its halt levels are about 15 cents below and 15 cents above the current price, $1.26 and $1.56. But notice INVO. INVO right here is a similar price. It's at $1.43, $1.44, but the halt levels are 113 by 169. Why are the halt bands wider on this stock? Well, notice that this stock is down 30% on the day. So this stock actually falls into this category right here because its price at yesterday's close was between 75 cents and $3. So the volatility bands are 20%. Isn't that odd? That you have two stocks that are basically the same exact price, but they fall into different rules for the halt levels. Unfortunately, this is one of those sort of little idiosyncratic moments of our current market. The volatility bands are designed to prevent flash crashes. They're designed to protect individual investors and traders, instill confidence in the market. But this is an area where when you have a stock that's halting every 15 cents and spending more of the day being halted than actually trading, it feels borderline untradeable. And it actually feels like, as a trader, it's not safe to trade it, because at any moment someone could execute a 500,000 share sell order, boom, it's halted down, and you don't have a chance to get out. You're stuck. So on the stock that went from 20 cents all the way up to $11 a share, I was trading that only pre-market and after hours. During the regular trading day, it was too difficult. So I waited until pre-market and after hours when the circuit breaker halts were turned off, because that's when it was more fluid. That's when it was trading more naturally. But even still, I don't usually like penny stocks because even pre-market, they still have the first two issues that I mentioned. The issue with the decimalization, so they trade in with really tight spreads and they don't move very quickly, so it's hard to scalp 10-15 cents on it. And then number two, they're very thickly traded. These are the two main issues. And then the circuit breaker halt issue, that for me just kind of puts it over the top. So if we look at my own metrics, I always draw on my metrics because this tells me what I'm good at. So what my metrics show is that my profitability predominantly, really in a big way, is on stocks between $5 and $10. Do I make money under $5? Yes. Do I make money under $2? Some, but not a lot. Now, this is just for this period of time right now. We could clear this out, and we'll see if I clear this out and we show it for all time. You're gonna see it's a little bit less. It's a little less distinctive. Let me just scroll back. So you can see right here. This is for all time. All right. So for all time, it's still predominantly in the 5 to 10 area. This year was what we were looking at before, is even more so. And yeah, under $2, $350,000. I've made $350,000 on over $10 million in profit. It's 3.5%. So I could just say, I don't need to ever trade penny stocks. And I could say I don't need to ever trade a stock over $100 a share, but GameStop and a few others I traded and I made some good money on. So, it's okay to trade a little outside this zone, but I have found consistently that trading stocks that are a little bit more expensive, for me, it feels simpler. The halt levels, if it's above $3, the halt levels are 10% away. So that means a $5 stock can go up a solid 50 cents before running into a halt. And it's more than just going up 50 cents, because again, it would have to go up 50 cents in 1 minute to get halted. If it goes up 30 cents, it's not going to get halted. And then because the halt level updates, because of recent price action every 30 cents, that halt is going to keep climbing higher. So you can have stocks that go up 300, 400, 500% and they don't get halted once. But it's usually the ones that start above $3 that give that type of cleaner price action. And that is more tradable. So, to me, there's this big flaw with penny stocks that you've got the issue with decimalization. You've got the issue with them being super crowded. And then number three, you've got these crazy halt issues, which have been really noticeable in the last couple weeks, these back-to-back-to-back halts. So my approach is that if I'm going to trade them, I'm going to trade them pre-market or after hours. And in general, I'm going to focus on trading stocks closer, between $5 and $10, because that's what my metrics say is where I'm going to make the most money. If you found this interesting, I hope you hit the thumbs up and make sure you tune in for the next episode real soon.